Hello and welcome to Diaspora Careers and Investments. This video is part of a series of videos that I'm recording on how to own your own home. In this video, I'll be explaining how to get a good mortgage deal. Stay tuned. Hello and welcome back. In today's video, I'll be explaining to you how to get a good mortgage deal. To use the expression a good mortgage deal suggests that there could be a bad mortgage deal. If you've not seen the Chris Rock video on what a bad mortgage is, you should look it up. It's really funny. In that video, he explains that a bad mortgage is one that does not allow you to do anything. A bad mortgage does not allow you to buy a new pair of sneakers or go on vacation or even quit a bad job because the mortgage has to be paid. And I tend to agree with him because mortgages tend to be, larger amounts to be paid over a long period of time. And so you want to get a good deal because a bad deal could tie you in something, for a long period of time. So then, how do you get a good mortgage? For many of us in the UK or, US or Canada or New Zealand or even Africa who want to buy a house, rarely do you have all the money to buy the house for cash. And so you would want to go for a loan to help you buy the house. So a loan to buy a house is what is simply known as a mortgage. And because these are usually, larger amounts, it takes a longer time also to pay. Before you get a good mortgage deal or even any loan for that matter, you need a good credit score. If you've not already seen my video on how to get a good credit score, I strongly recommend it. And I'll put a link to it in the description box below. So, assuming you've got a good credit score and so you're likely to get a loan for a house or a mortgage, the next thing you need to do is to get what is known as an agreement in principle or a decision in principle. An agreement in principle is simply, a document or, a bank agreeing that if you find a house of a particular amount, they are committed to giving you, the loan to buy the house. And this is important before you even go to search for the house because you want to know how much loan you can get before you go and, search for a house. If you have a decision in principle for a loan of, say, £200,000, you don't go about searching for, a house costing 300,000 unless you have, 100,000 in the bank. So you want to be sure that you've got an agreement in principle before you start even searching for your house. And you want to know the maximum the bank will be ready to lend you. It also saves you your own time as well as it saves the seller's time because it will be annoying that you go see a house that you want to buy and then, at the end of the day, you apply for the mortgage and the bank says that, sorry, mate, we can't give you the loan. It's a waste of your time as well as a waste of the seller's time. So you want to get an agreement in principle or a decision in principle before you go searching for the house. So how do you get a good mortgage deal? It all comes to a few things which I'll list here. First is your affordability. Here in the UK, the bank uses, a general rule of thumb of 4.5 times your gross annual income, all things being equal. So assuming that you earn, say, £40,000 a year, the bank would usually lend you a maximum of 4.5 times the gross of that, which is 4.5 times 40,000, which is about 180,000. So if you earn 30,000, the bank will lend you 4.5 times 30,000. Assuming that, your other finances are okay and you don't have any bigger debts, these can affect your affordability. If you earn 50,000, then the bank will usually lend you 4.5 times 50,000. That is usually the maximum amount they will lend you. I've seen some articles that says that, given the COVID and, the inflation and all of that, the bank should scrap that rule. But the banks have really not scrapped it. But if you are a couple, the bank would usually use the sum of your, of your annual income. So assuming that you earn, say, 30,000 and your spouse earns 40,000, the bank would usually use 3.5 times 70,000, which is the sum of your income, which is about 270,000. So it means that for two persons who are both working, the bank will use, the sum 3.5 times the sum of your income. So that is your affordability. So now that is where to actually start from. So if you earn, let's work with, say, 40,000 as a single person, say you earn 40,000 and you want to go and buy a house, you know that the maximum amount a bank will lend you is 4.5 times 40,000, and that is about 180,000. So if you want to buy a house costing, say, 200,000, then you should have, 20,000 down to add up. If you want to buy a house costing 300,000, then you should have, say, 120,000 somewhere to pay the difference, because the maximum the bank will lend you is 4.5 times your gross income, or 3.5 times the sum of two persons' income. The next point that can influence the kind of mortgage deal you get is your deposit. Regardless of the house you want to buy, the lenders or the bank would usually expect you to put down a down payment to show that you are committed or you can afford to buy the house you want to buy. This is different from the affordability test I've explained earlier on. Usually the bank should expect you to put down, whether 5% or 10% or 20% or even 30% or even sometimes 40% of the value of the house you want to buy as evidence that you can afford it. So, for example, if you want to buy a house costing 200,000 and the bank wants you to put a minimum of 10%, then that is, you should have 20,000 to put down towards the house. Generally, the bigger the deposit that you put down, the lower the interest rate, and so the better the deal. I would generally tend to say that if you can put down 10%, that should be the starting point, because the interest rate around 10% going is better than 5%. And some banks even don't take any deposit at all, and those can give very high interest rates. So you really want to shy away from that. The kind of interest rate you get can also be influenced by your immigration status or your financial circumstances. There are some banks which will lend you the money even if you have a poor credit score, but that means more risk to them, and so the interest rate will be higher. But there are some banks also who would not lend to somebody who is not a citizen or doesn't have permanent residency. In fact, Barclays and Halifax are some of the banks that are very kind to immigrants or people on tier 2 or skilled worker visas. They tend to give them mortgages, so you can go to them for a decision in principle. But then you want to go with a good down payment or a good deposit so that the interest rate you get can be good. This is especially important because of the global inflation that is going on. Previously, about a year ago, you could get a mortgage rate for about 1.5% or even 1.8%, essentially under 2%, if you put down 10% deposit towards the house that you want to buy. But these days, you'll be lucky to even get 2.5%. And while you may think that the difference between 1.5 and 2.5 is just 1%, now think of it as 1% of 200,000 loan. The numbers can add up. So this is so crucial that I want to highlight again. You want to have a good deposit. And remember, the deposit is not just about the amount of money you put down. It is the percentage of the house you want to buy. Because if you want to buy a 100,000 house and you put down 20,000, that is 20%. But if you want to buy, a 20,000 house and you put down 10,000 or 20,000, that is, 5% or 10%. And so you want to put down a good proportion of money down. So I think that is also one of the places you want to start from, how much deposit you have to influence what kind of house you want to buy. As a rule of thumb, aim to put down at least 10%. So this could mean that you wait a little longer to increase your, deposit, or you go for a cheaper house so that you can afford it. That would be my advice. So with that said, the next thing to do is now to go onto the home searching apps, and you can use whether Zoopla or Rightmove or S1 Homes or Google. In fact, the apps are so many of them. I can put some of them in the description box below. And now you can go and search for the kind of house you want to buy. I have a video coming up on what kind of house I think you should buy, depending on your needs, whether it's a flat or or a house. You can now begin to search for the house you want to buy. So you go search and then you realize that the house you want to buy is, say, 150,000 or 200,000. That is the kind of house that meets your needs. Now you can assess what is the maximum amount I can borrow from the bank and what deposit do I need to put down. So that is where you also want to do it. I've already got a video on a lifetime ISA, which really helps you to save towards buying your first home here in the UK. I'll put a link to that also in the description box below. If you've not seen that, I strongly encourage you to have a look at that. Of course, it doesn't mean that you should wait, to save, 50,000 or 100,000 before, you make a move to buy a house. All I'm saying is that make sure that at least you have at least 10%. That will be my rule of thumb. You have at least 10% to put down towards the house. Of course, the deposits, the proportion that you put down is also different. If it's a house you are planning to rent out, if it's an investment property, then the banks may even require higher deposits. So you want to find out, that. But 10% will be my standard for a residential mortgage. And so that leads to my final point on how to get a good mortgage. Depending on the interest rate that you get from the bank, you really want to calculate what does that translate into monthly mortgage payments. And what you really want to do is to check of the monthly mortgage payments or the monthly loan payments that I'll be paying back to the bank, what proportion of that, goes towards paying the principal and what proportion of that goes towards paying the interest? Because let's say you buy a house costing 200,000 and then you put down 10% to 20,000 and then you go for a loan or a mortgage of 180,000 and you are given the interest rate at say 2.5% to be paid over say 35 years or 25 years. How much of the monthly payment goes towards paying the 180,000 and how much goes towards paying profits or interest for the bank? So there are several mortgage calculators, which I'll put a few of those in the description box and kindly use it. So from what I have, the numbers I'm using currently, if you go for a loan of 180,000 for a 200,000 house, and so you put down 10%, which is 20,000, your monthly payment comes to about £645 per month. But then if you get it for 2.75%, then your monthly payment comes to about 670. So yeah, it doesn't seem like a lot of difference, but if you're paying that over 2 years or over 10 years or even 20 years, then whether it's a £30 difference or £40 difference, it begins to add up. That said, you want to know how much of that money is going towards paying the principal and how much is paying the interest. So I'll work with the 2.5% for a loan of 180,000 towards a house 200,000, which you put down 10%. You will pay about £645 per month. I know you are thinking that currently my rent is already £600 or £700, but you could go for a mortgage, a loan of 180,000, buy a house costing 200,000, and still your monthly payment will be about £645. So yeah, it could work out well. But the real question remains that how much of that £645 that you are paying every month is going towards defraying the principal, the 180,000, and how much of that is interest? It works out that if you go for a 180,000 mortgage to buy a house costing 200,000 at 2.5%, you'll be paying £645 per month, and of that, £375 goes towards interest, and then 270 goes towards the principal. Yes, I'll say that again. So the majority of that 375 is interest that goes to the bank for free. And then 270 reduces the principal amount of 180,000 you've already borrowed. So you already realize that you need to check these numbers well. So the fact that, my mortgage is only £500 per month, or only £600, or only £800 per month, does not mean that all the £800 is going towards the principal, is going towards reducing the loan amount. No. There's a fraction of it that reduces the loan amount, and a fraction of it goes to the bank for interest, for giving you the loan. And that is the point I really want to emphasize. I remember a friend of mine, approached me that, Sharak, I want to go buy this house. The bank says I can put down only 5% and they'll give me the loan at this rate. And I went through this with her, calculated the amount she'd be paying every month and how much of that was actually towards interest and how much of that was towards principal. And it worked out that the amount she'd be paying every month towards interest only was about 500, which was more than her current rent, which was about £400. So it was obvious that if the amount which is going towards interest is even more than your current rent, then maybe it is not a very wise decision to go for that mortgage, because if your rent is currently lower than the interest on the mortgage, then did you go or did you come? So you really want to, put down a lot more deposit or go for a lower house or a cheaper house, so that the interest that you pay on the mortgage is affordable. It is not more than your current rent. It is manageable, and then the proportion that is going towards the loan or the principal is is better. And that is where I'll leave it. I'll put a lot of links in the description box below towards how you can calculate how much of your mortgage is going towards interest and how much of that is going towards the principal. And let me know in the comment section whether you have a good mortgage or whether you think you don't have a great deal. So I hope you found this video helpful, and whether you are now thinking of going for a mortgage, or you are refinancing or remortgaging, or you even have a current mortgage you are paying, I hope this really helps you when you're at that point where you want to remortgage, to know, to be able to do these calculations, to know whether you have a good deal or not a so good deal. So let me know what you think of this video in the description box, in the comment section. Thank you, and stay blessed.